What's good, all my trader and investor homies? It's your boy Kevin. A famous, very smart philosopher once said, "Are you dumb, stupid, or dumb?" And today when I was doing my weekly Sunday scan, looking for some longer term investments, I was just looking at the stock market and thinking to myself, this is just stupid. Everything is extended. Everything is too expensive. The recovery stocks that were on discount just a couple months ago, they are approaching all-time highs now. How things have changed in just a few months. Growth stocks, expensive. Value stocks, expensive. There aren't very many good deals out there. So what do? Do we pull our cash out, keep it on the sidelines and wait? Or do we stay invested? Well, Cathie Wood from Ark Invest, she is calling for a 2021 stock market correction. She's one of the smartest, most bright minds in the investing world right now, but she is also advocating to stay invested. She says that if you pull your money out, put it on the sidelines, that you can miss out on some great opportunities, and I completely agree with her. But I think we have to switch up our investing strategies to match up with the current market conditions, and the current market conditions are expensive and extended. So what do? Well, that's what we're going to be breaking down in today's video. I'm going to be talking about my current investing strategy and how I'm approaching this extended market while staying invested but protecting myself from any downside correction. Let's talk about it. Let's break it down. All right, guys. So the stock market, there's no arguing that it is expensive right now. Look at this S&P 500 chart. We were trading down here on Rona lows at 220, and now we're currently at all-time highs. We rocketed up. Now we're trading at 380, pre-Rona highs of 339. Nothing is cheap out there right now. Everything is trading at pretty pricey levels. And Cathie Wood of Ark Invest is saying to stay invested. I completely agree with her, and I have been using a couple different strategies to capitalize on this expensive market. Stay exposed, keep your money in the market, but be careful. All right, before we get started, this video is brought to us by Touchdown Trades University. We just launched touchdowntrades.com, a 3-in-1 trading course, swing trading, long-term investing, and options. The link is in the description. Also, check out the link in the description for Webull. They have partnered up with the Touchdown Trades community, and they're offering us 4 free stocks valued up to $3,700 when you open an account with the link in the description and deposit $100 or more. That is free money. Don't miss out on that free money. So what do we do when there is a market that is expensive and we are scared that there's going to be a correction? Well, the first thing that I've done in my personal investing, my personal trading strategies, I have moved some of my money from longer term investing, and now I am putting more of my portfolio into short-term swing trades in small cap stocks and penny stocks. Why? Number one, penny stocks have less correlation with the overall stock market. Number two, swing trading, we have less risk on the line per trade because we're getting in with a smaller defined risk. We're buying in, we have a buy zone, we have a set stop loss, so we already know how much we're willing to risk going into that trade, and we have our profit targets. So when we buy right here at our buy zone, we already know our max loss. If the overall market goes into correction mode and starts to pull back and our swing trade goes against us, we stop out at our stop loss, we walk away and move on to the next one. You can't really do that with longer term investments because you're looking to hold those for a couple, 3, 4, 5, even 10 years. You can't just walk away from those when the market corrects. You want to cost average down, build to your position at and lower that cost base. Well, swing trading, we can walk away and move on to the next one. And if it does work out, we take our position off at our profit target. So it's already set for us before we even enter the trade. So how am I finding these penny stocks to swing trade? Well, I'm using a free tool called FinViz. It's absolutely free. I go up to here, I click the screener. It's a very simple process. I do it every single week, a couple times a week. And I have the criteria laid out. The first thing I do is go up here to market cap. We're looking for small caps, we're looking for penny stocks. They're less correlated to this overall extended market. And we're gonna go to micro, less than $300 million market cap. And then the second criteria that we want to incorporate into this scan is price. So we're gonna plug in price. If you wanna look for stocks under $10, under $20, under $15, that's up to you. I personally leave that blank. The next thing we want to do is we want to go to performance. Performance 1 and performance 2 over here. On the first section, we want to plug in quarter plus 30%. Second section, we want to go to quarter or week, down, or you can even do month down, but I'm going to go week down. What this is looking for is this is looking for small cap penny stocks that are trending up. Remember, they're up 30% or more on the quarter. On the week, they have pulled back. So we're looking for strong stocks. The trend is your friend. Take that away from this video. If you take anything at all, the trend is your friend. Don't try and fight the trend. So strong stocks pulling back. We can then look at the charts, find support areas to buy in front of, set our buy zone, set our stop loss, set our profit target. All right, so we also want to plug in average volume. Right here, we want to plug in average volume, 750,000 shares or more. We don't want to be trading low volume nonsense. We want to be trading stocks that have good volume so we can get in and we can get out. What else? We can also put in, if you want to put in float over here, lower float stocks are going to be more likely to make a big move, and also short float. Float short right here, if we can go to high, that's going to show us stocks that are very likely to have a short squeeze. So we only have one AYRO. Let's take a look at this stock. This is an EV stock, I already know. So we have a market cap of $182 million, a percentage of float short of 26%, and it's definitely been trending up and has pulled back. So this meets all the criteria for a swing trade. Then the next step I would do is I would go over here and I would pull it up on the charts and I would plug in the support and resistance lines. It's a very simple process. Once you get it down, you're good to go. So we got support right there. We're trading over support, and the simple strategy is you buy in front of that support, you set your profit target near or before those prior highs, profit target, and you set your stop loss under the support. So this meets the swing trading criteria that I look for, so I'll be putting this on my watch list for next week. And remember, the reason we're looking for penny stocks in swing trading is penny stocks, less correlation to the overall stock market. If the stock market has a down day, penny stocks, they really don't care about the overall stock market. Number 2, swing trading. We don't have to hold them for months and months, so we have less exposure, right? We know our risk because we're setting that stop loss. Once we get in the trade, it's pretty much automated for us. All right, let's move on to the second strategy that I've been using, and that's selling covered calls. I'm using this options trading strategy during expensive market. One stock that I've been doing this on is Hyliion, because I love Hyliion long term, but I'm not confident that it's going to snap out of this funk in the next couple of months, because there's going to be a few, maybe even a year or two before they start posting real revenue numbers. And I think the only way we snap out of this funk is beating earnings expectations. So what have I been doing? I own a bunch of Hyliion stock. I've been selling covered calls to generate some monthly, weekly income off of the stock that I already own that I think may just chop around for the next couple of months. So you go to the options chain. Remember, I own about 1,000 shares of Hyliion. So you can sell weeklies, you can sell monthlies, doesn't really matter. And this will generate you income. So basically what this is you own stock. You have to own stock in order to use this strategy. You can only sell one contract per 100 shares that you own. And we're selling call contracts above the trading price, say $20. We sell one contract, say for $1. So we're going to take in $100 for each contract that we sell. And then if at the time of the options expiration, Hyliion is trading under $20, we keep that $100 per contract in our pocket, and we keep our 100 shares of Hyliion. If Hyliion happens to rocket above $20 per share and close above $20 per share at the time of expiration, we keep the credit we took in from selling the covered call, and we lose our 100 shares of Hyliion at $20 per share. So this is a very good strategy for not only getting weekly or monthly income, but also lowering your cost basis. I've lowered my cost basis from about $22, $23 per share all the way down to like under $15 per share because I just do it every single week. I sell call contracts on the stock that I own, and for like $1 per contract, you do that 5-6 weeks, you're taking in some real income. So let's look at the options chain and I'll show you how I would do this. So I bought Hyliion stock at, let's say $23 average price. And then you go to the options chain and let's look at the February contracts. So these would expire on the 19th of February. Let's show 10 contracts. And I would be looking to sell these probably $20 strike right here. We could sell them for $1 per contract. So we're taking in $100 per contract that we sell. So if you own 300 shares of Hyliion, you can sell 3 contracts, you'd take in $300. If you own 1,000 shares of Hyliion, you could sell 10 contracts, you take in $1,000. And as long as Hyliion's trading under $20 per share, you keep your shares, you keep the credit. So basically you're becoming the casino, and the people buying the options contracts from you are the people gambling. The third strategy that I've been using during this expensive market is only investing in growth stocks. Why? Because I flat out don't think there's very many value stocks left out there that are cheap. Even the recovery stocks are expensive. The cruise liners are expensive again. The hotel stocks, the restaurant stocks, they're expensive right now. So I've only been investing in growth stocks where fundamentals don't really matter. The only metric that matters with growth companies is increase in revenue and increase in revenue projection. So I've been focusing on growth stocks. One growth company that I really like is Fubo. I did a video on this a couple days ago. They're getting into the sports betting industry, and we all know cable cutting is taking place. If you want to check out my thoughts on Fubo TV, check out playlist. It's down there. I did a video on it maybe 3 or 4 days ago. But yeah, focusing on growth stocks. So just to summarize it, my first strategy is swing trading small caps and penny stocks because of the lower correlation with the overall market. My second strategy is to use options to limit my risk, lower my cost average on my long-term investments that I already own. That's called a covered call strategy. I'll write out a description for covered calls in the description of this video if you want to check it out. And the third strategy that I'm using is only investing in growth stocks and leaving value stocks alone for now. Once we get a correction in the stock market, I will look for value stocks. I'll take some of that money that I'm using for swing trading right now to buy value stocks once we get that correction in the overall stock market. But this stock market could keep going. It very well could keep going, and the S&P 500 could be trading at $450 at the end of 2021. It very well could have. People have been calling for a rollover for the last 6 months, right? Up here, up here, up here, and it just keeps going higher. At what point do we have to say, all right, it can keep going, sure, but it's gonna go without me. I need to adjust the way I'm looking at this market. I need to adjust the way I'm investing in stocks, and I need to switch up my strategy to focus on an extended market. Now, we do need to stay invested in order to have a good 2021. We had a great 2020. We want to have a great 2021. We got to stay invested. But just in my personal opinion, we got to switch up the way we're doing things, and that's what I'm doing by using these strategies that I talked about in today's video. I hope you guys got something from it. If you did, go ahead and hit that like button for me. If you're not yet subscribed, go ahead and hit the subscribe button and turn on the notifications. I'll catch you guys in the next one. Until next time, peace.